Good morning, ladies and gentlemen, and welcome back to Boutiques on Wednesdays. To the end of September, we've had phenomenal returns from nominal bonds and fixed income funds. But in October, we had a sharp pullback in nominal bonds of about 2.2% in sympathy of rising bond yields in the US, despite recent rate cuts. This is just a reminder of how unpredictable markets can really be. All eyes on US elections, where both the red and the blue teams promise to spend more money. But could this increase the already heavy debt trap they face themselves with and push bond yields even further? How does this impact on SA bonds and fixed income funds? And how should we think about SA nominal bonds in income funds? Joining us this morning and here to unpack this and more, it is my pleasure to welcome back a very familiar person to all of us, Melanie Stockett, Head of Fixed Income at Laurium Capital. Good morning, Melanie. How are you doing?
Very well, thank you. How are you doing today? Good.
Yeah, all good, Melanie. Thank you so much for your time this morning. It's always great to have you on our sessions. If it's not live road shows, it's on the boutiques on Wednesday. So thank you so much. A lot of moving parts in fixed income markets at the moment. A lot more excitement, I think, than equity markets. But yeah, people are asking, where do we go from here? What's going to happen?
Very good questions. Absolutely. Thank you so much, Eugene. Thank you to the BCI team. It's always such a pleasure to present to all of you and to have a conversation with you. So really looking forward to engaging with you. After we run through a couple of the themes that are currently taking place, you'll have to forgive me. I've got one eye on the market, which I should probably just close because it's so distracting, because clearly today is a really, really big day for the direction of markets going forward. But perhaps if we could just start off very briefly. I know many of you are very familiar with Laurium Capital, but just a couple of call-outs before we get started. So Laurium Capital has been around for a long time. Actually, I'm actually going to close my Bloomberg completely so that I don't look at it. We've been around for 16 years, so quite a depth of time. We've got a very diverse team. We have people from all sorts of different backgrounds and different experiences. We're also very proud of the transformation journey that we have walked in recent years. And we don't just manage money across South Africa. We manage global capabilities, both from a global equity perspective standalone, but also we have multi-asset funds which do invest in offshore fixed income. And we also invest across the Africa continent. So both in the equity space as well as the bond space, we've got an Africa bond fund that we manage. So that really gives you a lot of broad perspective of the different themes across the globe. We've got 57 billion rand assets under management, and that still makes us a boutique, but I think I'd say one of the larger boutiques. It still allows us to be nimble, opportunistic, and flexible. The investment team I've just pulled out onto the slide here, but I just wanted to highlight the fixed income team. So we're a team of three. You can see myself there in the middle and very ably assisted by my powerhouses of Shwebi on the fixed income analyst side, and then CZ, who's our credit analyst. So I'm sure many of you are familiar with both of them as well. Right, the three most important factors driving South African fixed income markets. So I could probably list 10, but let's just start with three. For those of you who are familiar with me, you would have seen this before. I always, when we talk about SA fixed income valuations, I always suggest that we look at it through three distinct valuation pillars. The first one is what's happening to global yield. So as we know, South Africa bond market, we're a very, very small component of a very big global bond market. And the epicenter of solar system, if you will, everything else revolves around US 10-year treasuries. So we have to spend a lot of time thinking about US dynamics. We then think about SA-specific dynamics, what's happening to our growth cycle, inflation cycle, how the SARB is going to respond to those with interest rates throughout the different cycles. And then the third pillar is when you're investing in South Africa, you clearly carry different risks than if you're investing in the US. So from a bond perspective, what credit risk do you need to be compensated for by taking on SA-specific risks? So if I had to call out three questions that relate to these pillars, the first one would be in the US, how much is the Fed going to cut interest rates by and why? In South Africa, very similar. How much is the SARB going to cut interest rates by and why? Very important for income funds, which we're talking to today. And then the third pillar, South African risk premium, post this really lovely GNU rally that we've had that's compressed our risk premium. Is there still room for this to run further? And what could be the reasons why that could continue to compress? Right, so if we start just with developed markets first, so kind of zooming out onto the global stage, we've got here the Fed fund rate, so US interest rates in red, and then the US 10-year bond yield in gray. And you can see if we just look towards the right, US interest rates, as we know, outsized interest rate increases post-COVID. So we had a very short and sharp interest rate hiking cycle. Rates then went on hold. We all remember higher for longer, looking around the corner the whole time, waiting for that first interest rate cut to come through. At the last meeting, we had that first interest rate cut, and it was bigger than expected. It was 50 basis points. But if you had to just zoom out for a second and have a look at, where we are relative to history, you'll see that interest rates, even after that 50 basis points cut, interest rates in the US are still at the high levels that we saw all those years ago before the global financial crisis. And US bond yields, which is the gray line, which also had that really, really big rise post those abnormally low COVID low levels, have moved all the way back also to GFC, and yield has been restored to the bond market. So where to from here? We've got US interest rates at 5%. Every time you before you have the first interest rate cut, you'll know, we're completely obsessed about when is that first cut going to come through. And as soon as that cut happens, the market moves its focus very quickly to where are rates going to end up in the cycle? So what is the terminal rate going to be? Where will rates be cut to? And how quickly are we going to get there? And that's very much the mode that we're in right now. So we have interest rates in the US at 5%. Where could they fall to? If we have a look at the Fed, they do guide us on what they think their long-term neutral interest rate is. It's been ticking up a little bit in recent times, but if we look at their latest Fed dots, they've got that long-term interest rate where neutral rates are over the long term at 2.875%, round that up to 3%. So they're at 5. They think they're going to get to 3 over time. There are two things that we can see immediately there. 5% interest rates are seen as restrictive, so higher than usual. And secondly, the Fed does have quite a lot of scope to cut rates further. So if we think about that journey, first of all, we have to think about why interest rates are being cut. If we have a look at the left-hand side with the US in red, we know that US inflation, like all other countries, surged post-COVID, come back down again, back to much more palatable levels, very close to target ranges. So the inflation job has largely been won for now. There are obviously lots of upside risks to that. And then we look at the right-hand chart, which is policy rates for other developed markets. The Fed absolutely wasn't the first one to cut in the cycle. We saw a number of developed market central banks move earlier than the Fed. And if we just look at these ones here, Eurozone, for example, has already cut 3 times this year. The UK moved earlier. The Fed was actually quite a late starter to the cycle. So if we think about the path that might be followed, so what will the Fed do next? We obviously have a meeting this week. We think that they'll cut 25 basis points, but what is the ultimate end goal, the destination for interest rates in the US? One way we could answer that question is to have a look at the markets, what markets are pricing in. If you ask the market on any given day, they're going to give you a different answer. This is where we were earlier this week. I will see where we are post if all the news settles today. But it looks like a busy slide. But essentially, you can have a look at where the trough in the interest rate cycle is anticipated to be. So we're at 5. The market says we're going to get to around about 3.6%. This changes all the time. So if we had to have a look at this graph in September, so very recently, the market was thinking that interest rates were going to fall all the way down to below 3 to 2.75. We had some bad payrolls data out of the US. The market can swing around quite quickly and quite significantly. And the reason for this is because the Fed themselves, they tell us that they are data dependent. So they're going to change their mind depending on the data that comes in, which does, of course, introduce uncertainty into the market. So the way that we like to think about it then is to tease out the different paths that we could follow and then compare that to market pricing. So where are we going to? We have to answer the question is why is the Fed cutting interest rates? And we think about it as 3 broad terminal rate scenarios, so where interest rates are going to trough in the cycle. And you'll know the narrative about different landings. So economic landings, is the US going to have a soft landing where they go back towards trend growth, so everything still stays not too hot, not too cold, kind of Goldilocks? Do they have a hard landing? are recession fears rising? Are we going to see a loss in economic momentum? Or is there actually going to be no landing, which is the narrative that's been building up in recent weeks, where the market is looking at economic data saying it's really strong, and that actually maybe the US stays much higher growth rate relative to its trend rate for a little bit longer, despite high interest rates. So underneath all of those scenarios, we can sketch what we think is a reasonable terminal rate. Under no landing, we would think that's around about 4%. Fed is restrictive. They want to cut interest rates to some degree. 4%, still quite a bit higher than their 2.875 or their 3% long-term rate. We think that that's a reasonable scenario. Soft landing, which is what they currently have priced into their forecasts, would be around about a 3% terminal rate. So we'd move from 5 to 3. And then a hard landing, obviously, if we see a loss of economic momentum, the Fed is likely to cut a lot deeper and a lot more quickly and get down to at least 2%. As we discussed, the market currently pricing in about 3.6% as the terminal, so much closer to a no landing scenario than any of the others. So we would think, if we extrapolate that through to bond yields are trading at the upper end of what their fair value range should be. Obviously, you throw some other things into the mix there, like fiscal risk premium, depending on the cocktail policies that come out after results today or whenever we get them, and things could change. So let's maybe just pause for one moment and think about the US elections. It's just thinking about it very simplistically. If Trump were to win, if he comes with a trifecta, which is quite an interesting complex for us as fixed income managers to unpack. The first one is taxes or deregulation. That would be positive for US growth. So that's what equity markets are looking at. They're saying that would be great. We want Trump in because he's going to deliver high economic growth outcomes, which is good for equity markets. The problem is that he comes with other policies as well. So the second string would be tariffs or trade policy. Those are always stagflationary. So they hit economic growth. So growth will be lower, but they're also inflationary at the same time. So that's not a pleasant mix for markets to have to deal with. And then the third pillar or the third arrow of his policy strategy would be immigration. So cutting off immigration, which we know that the flow of immigration has been really good for US economic growth and has helped to bring inflation down. It's kept a lid on wages. So that, once again, negative for growth and more positive is an upside risk to inflation. So what makes this tricky is that we don't know exactly what he's going to implement if he does take up the presidency again, because he's known to be very unpredictable, and also the timing thereof. So this will keep markets on edge. They'll price in a risk premium for these risks. Moving on from the US, let's talk about South Africa and where we are in our interest rate cycle. We've graphed here the South African interest rate in blue this time, and then South African inflation rate in red. And as we saw with the US, we saw quite a steep tightening cycle post-COVID. Interest rates were hiked quite quickly. They then went on into this extended pause period, and we've also seen our first interest rate cut, but only 25 basis points relative to 50 in the US. The same time, inflation, which did also move significantly higher post-COVID, has come right back down to the target range again. And if you look at the dotted line, we're using ABS's forecast here, you can see that it stays really well behaved in the near term. So inflation is not the concern in the near term based on current forecasts. Our Reserve Bank is an inflation targeting central bank, as we know. So what is their job? Their job is to keep inflation between 3 to 6%, but they target the midpoint, 4.5%, which is the dotted line we have here. So you'd look at this and you'd say, this is all under control. How much more is the SARB going to cut? Because they obviously must have a room to cut if interest rates, if inflation is looking so subdued. And I raise this because this is a conversation I must be having at least once every day with our equity team, where they clearly want interest rates in South Africa to fall quickly and aggressively because that will spur economic growth and spur equity valuations, which is fair enough. But what I say to them, which is what I've said in these forums in the past, is that when we're looking at forecasting interest rates, we have to think about what the SARB is going to do and not what we want them to do. And those can be two very, very different things. Fortunately, the SARB tells us what they're going to do, the types of scenarios that they're thinking about. And we saw an update recently in the SARB's Monetary Policy Review, which was released 2-3 weeks ago, which went into exactly this question. They sketched out 3 different scenarios and they gave the result that their model showed for what interest rates could do under those scenarios. So let's very quickly unpack those. If we have a look on the left-hand side, these are the scenarios they run on inflation, and the right-hand side is the response with interest rates. So baseline on the left, very similar to what I showed you on the previous chart. Inflation falls below the midpoint and then goes back up to the midpoint again by next year. So nice subdued inflation outlook, but still settling at the midpoint of their target. What they would do under that scenario with interest rates is they'd cut a further percent. So we're currently at 8% on the repo rate. They would cut another percent to get us to 7%. So that's the baseline. That's kind of what's baked into market expectations. That's where we stand right now. However, they've run two scenarios relative to that baseline. One is if we see upside risks to inflation. So if you have a look at the left, you can see that inflation moves down in the near term and then shoots up again. The scenarios that they've run, it could be a lot of different things, but the ones that they've run relate to electricity tariffs, which we know a bit of a wild card next year. Eskom's applied for eye-wateringly large tariff increases. We're not too sure what NERS is going to allow, so that's one upside risk. They've shopped for higher wages. They've shopped for higher rental inflation. You can see that inflation moves up. They would then have less scope to cut interest rates. Have a look at the right-hand side. By 2026, they would only have cut another 60 basis points. So call that another 225 basis points from where we are now. So that's the bearish scenario. What everyone's obviously focusing on is what about the bullish scenario? How low can rates go if things move in South Africa's favor? We have a look at the left-hand side. What they've done is they've shot their model through the rand. So they've taken the rand 24% stronger relative to their baseline. Inflation moves down relatively quickly to 3% and hovers around that range. So that's pretty optimistic scenario. What would they then allow in terms of interest rate cuts? You can see on the right-hand side, the dotted line at the bottom, that would allow for much deeper interest rate cuts to come through. By 2026, the end of their forecast period, rates would be at 6%, which is a full 2% lower than where we are now. So I know we spend a lot of time talking about interest rates, and those would be the parameters that the SARB would likely move in. Right, moving on to South Africa's risk premium then. One way for us to sketch out what is the SA-specific risk premium priced into our bond yields is to very simply take our South African bond yield, here we've taken the 10-year, take the US bond yield, and subtract the one from the other. The differential is going to be the South African specific risk premium. And if we have a look at this chart here, we can see that post-COVID, 2020, 2021, and thereafter, this was very, very wide. There was a very high risk premium on offer for you to invest in South African bonds, obviously for good reasons, leading up to the elections, and then we've seen a compression in that risk premium since elections. So the question that we all obviously grappling with is there further room for the spread to compress, or have we done all the work and we might actually move a little bit wider? To answer that question, we need to think about that in two ways. The drivers will either be relative drivers, or they will be absolute drivers, or a combination of both of those. So let's start with the relative drivers. Thinking about where we are in the cycle right now, we've had interest rates in the US rise quite quickly to really attractive levels for investors. You can invest in a US money market account, get 5%, 4.5%, 5% interest rate. You don't need to look much further to satisfy your yield requirements if you're a global fund investor. But at some stage in the cycle, as US interest rates fall, investors are going to start to look for yield again, and they're going to look out at developed markets and back to emerging markets to satisfy some of that yield. What's important for South Africa is then that we are seen as investable within that space. So it's not only South Africa, but all emerging markets have seen less interest from foreigners in their domestic bond markets in recent years. You can see that very clearly here if you look at the percentage of foreigners, what they hold of the South African bond market as a whole is the red line. That's obviously been declining over time. It's the same for most emerging markets that we look at. If emerging markets come back into favor, investors are looking for yield, and South Africa looks investable, we would anticipate that this share would start to increase again, which obviously would be one of the drivers that could move that risk premium lower. We could see further compression and a rally in bond yields. Now, I've said for many on many forums recently that South Africa has very much been in the naughty corner for many years. So we weren't really seen as that investable. You had to have quite a lot of risk-seeking appetite to take on South African bonds. From a global perspective, they can invest anywhere else in the world. Now we're actually on the right side of that. So we look like a relatively clean story relative to other emerging markets like Mexico. That's going to have a whole lot of issues now with potential tariffs. They've also passed some really investor-unfriendly legislative changes to their judiciary. So a couple of questions to ask there. India also had some election wobbles. Now, other emerging markets all have their own idiosyncratic issues. South Africa's looking relatively good. Right, so that's relative. What about absolute? Can South Africa's credit risk premium improve on a standalone basis? Now, one way when you're assessing the credit risk premium of a sovereign is just have a look at the state of their balance sheet, which we do by looking at South Africa's debt to GDP, which we've shown you here. It's obviously at very high levels, right? We've jumped significantly in recent years. The good news, though, is that it does look, I'm using National Treasury forecast from the medium-term budget policy statement last week, it does look to peak in the near term and then start to come back down again. Just a very quick sidebar with the medium-term budget, because we haven't spoken since then. It was last week, so quite fresh news. What are our takeaways? As you'll know, we get 2 updates every year on the fiscal side. We get the big budget in February, and then we get the medium-term budget policy statement in October, which just gives you an update on developments since February. And the bottom line from this update was that it was, you could use the words responsible, pragmatic, but it was slightly underwhelming relative to expectations. We had anticipated that under this new GNE world, we would have seen a better growth outlook penciled down by National Treasury. There are a couple of reasons why there was a little bit of underperformance relative to expectations. We'll run through those, but essentially the bottom line is that National Treasury are guiding us that the primary fiscal anchor that we look at as investors and that National Treasury have committed to achieving is a primary surplus. A primary surplus would be debt stabilizing. It would mean that debt to GDP level, which has been rising so quickly, would stabilize and start to come back down again. Very briefly, what is a primary surplus? If you think of a government's budget, they raise a whole lot of revenue, primarily through taxes from the economy, so that's their money in. They then spend that in whatever the budget dictates, so education and healthcare and social grants and so on and so on. If you take the revenue less the expenditure, you're going to get the primary balance. You really want that to be positive. So you want to be earning more in revenue than what you are spending in expenditure. We've had that mix wrong for many, many years. But then the third component is that then you take the cost of servicing your debt, your interest costs off that to get to your fiscal balance. So that's just a little bit of fiscal math. But essentially, when we're looking at that primary surplus, so revenue less non-interest interest expenditure, that should be positive. We did achieve a primary surplus as a country for the first time last year in 15 years. So it certainly hasn't been the norm, and it is a big shift in the change to the outlook. And National Treasury have committed to achieving that primary surplus for every year throughout their forecast period. And that's the reason why debt to GDP that you see on this slide peaks and then starts to come back down again. So that's good. That's what we want to see. Where the fiscal slippage was, why there was a little bit of disappointment by the market, was on a couple of factors. The first one was on the revenue side. Revenues that are now being penciled in are a little bit lower than what had been expected in the budget in February. The reasons for that are really quite ironic, quite load shedding influenced factors. For example, customs duties and import VAT, lower than expected because we're not importing all of this big capital equipment for solar panels and so on at the same intensity that we did before. And then secondly, fuel levies are lower because we don't have to buy a whole lot of diesel for operating and running generators. So that's a little bit of irony on the revenue side. It's kind of a good news revenue miss. On the expenditure side, it wasn't fiscal slippage in terms of bad spending. There were a couple of things that needed to be done, like SANROL dates. We're not going to see the e-toll model rolled out anymore, so that government guaranteed SANROL debt has to be repaid. They're putting more money into SARS, into the receiver of revenue, to be able to generate more revenue on taxes. So that's something that we would support. And they're also putting in place an early retirement incentive package for the public sector workers. They tried to do it a couple of years ago, they're doing it again now, really just to revitalize, rejuvenate the public sector. So those are all things that we'd say are relatively good news. And then also their growth forecasts are very, very conservative. So hardly changed from February. And I think we'd all agree that between February and now, we're all feeling a little bit more optimistic about South African growth outlook. Treasury have got Operation Vulandlela. They are putting a large focus on infrastructure in the budget. We would have anticipated them to have penciled in higher growth numbers. They didn't. For us, that shows quite a conservative leaning. They show upside scenarios in the text of the document, but just not in terms of headlines. So that feels to us like a little bit of padding, some upside risk that could come through. So the result of all of that was that we've got a debt consolidation forecast or profile, peaks a little bit higher than had been expected in the budget, 75.5. The budget said 75.3, but then a more gentle consolidation trend thereafter. Our net conclusion after giving you all of that information is that we're really in a holding pattern now. Treasury's in a holding pattern. They're going to hold the fiscal line and wait for actual growth to come through. And then we should see that translate into positive numbers relatively quickly thereafter. Very quick reminder why growth is important, so important for us as bond investors when thinking about those fiscal metrics. I've shown you this chart before, it's an RMB Morgan Stanley chart, but just have a look at the blue lines. On the left-hand side, if we achieve higher economic growth in South Africa, quicker than expected, so we get quite quickly to say a 2.5 to 2.6% growth rate. If you look on the right-hand chart, you can see debt to GDP, which we looked at in the previous slide, consolidates very quickly and actually starts to drop off relatively quickly. So very sensitive to growth forecasts. Right, I wanted to have another sidebar where we talk about this GNU euphoria. So we were talking about GNU and how the market applauded it, and we've seen some really good positive sentiment as a result of it. I know that there are going to be cynics amongst us. I mean, all of us have probably been around the block a couple of times in the South African market. What makes this time possibly different to what we've seen before? So Ramaphoria and all the other times where we've had the stop-start economic growth reform journey that we've been on. And for us, there are a couple of clear takeaways. What we have right now relative to, for example, Ramaphoria, is that we've got a very clear economic reform plan that's under Operation Vulandlela, and it's run by that engine. So Operation Vulandlela, it's a joint venture between National Treasury and the presidency, and it's got a very limited number of high impact priorities. I mean, this is really, really an impressive operation. Initially, they've only had 5 impact priorities, the 5 pillars that they're focusing their energy on. It was energy, still is energy, logistics, water infrastructure, which we know is going to need a lot of attention, visa reform, digital telecommunications, and now they're going to add municipalities onto their next journey. It's important to have a small number of priorities so that you can make a difference. And we can see what a difference they've made in the electricity generation space. And what's important is that that blueprint of Eskom, of how we solve the Eskom crisis, shows the success of including the private sector and letting them be part of the solution. Private sector is so key for 2 reasons. They bring in skills, which of course we want when we're solving complex problems, but they also bring funding. And when the government balance sheet is so stretched, you really do need that additional funding to come in. So why I'm pointing this out is that we've had so many constraints in the past with ANC ideology that has not wanted to include the private sector. And it's been frustrating for years and years and years. And now we have an administration or a government that's actually actively inviting the private sector to be part of the solution. That's a very key difference to what we've had before. These initiatives are also driven by the presidency. So you've got political capital invested in this. You've got ownership, you've got buy-in. We haven't seen this in the past. As I mentioned, on top of all of this, we now have this GNU. So this government that's got all sorts of different parties in, it does loosen the constraints of that ANC ideology that we've bumped our heads against so many times in the past as investors. It introduces competition across ministers and ministries, checks and balances in parliament. And the net result of all of this is that if I have to dial back a year to when we were preparing for the medium-term budget this time last year, we all saw 2% growth rate in South Africa as being completely elusive. We were all penciling 1%, 1.5% into our numbers, thinking that we were never going to stabilize debt to GDP with that. If I now look at the Bloomberg consensus forecast for economic growth in 2026, that consensus is 2%. So that's really, really important. In addition to that, the risks to the growth outlook are seen to be on the upside. So those are all very key points I wanted to share with you. I know we don't have too much time left, so what I will quickly do is just run through then what this all means for fixed income valuations. Here we've shown the SA 10-year bond yield. We can see how since the elections, we've had a really strong rally in SA bond yields across the curve, being driven by some rally in US 10-year bond yields, and then the South African specific risk premium also compressing. So it's come from two sides. We've obviously given back a little bit of ground after that strong rally recently. Where to from here? So bond yields are still very high. We have taken some risk off in our portfolio. So we have taken advantage of that rally, but we still are including bonds across all of our multi-asset portfolios, including the income fund, because yields are still quite high. And we do think we're at the very early stages of a structural improvement in our risk premium. So still a lot of value left in bond yields. It's just a time for us to be more tactical. We also see opportunities elsewhere within the fixed income market that are also, we think, enormously attractive. If we have a look at inflation-linked bond yields, here we've taken the 10-year, you can get close to 5% for a 10-year inflation-linked bond. 5% plus whatever inflation is gives you a guaranteed 5% real yield. You have to include that within income fund type portfolios from a portfolio construction perspective to achieve our goals and our aspirations, our return aspirations over time. So lots of attractive opportunities that are still in place. Moving very quickly onto the portfolio, performance has been great. Obviously, we've had a really, really nice rally in fixed income assets, including across the bond curve and across other assets that we're invested in. So very attractive. The All Bond Index, as an example, year to date is up 14%. So very, very strong returns as that risk premium has compressed. We've, from a fund perspective, significantly outperformed our benchmark, outperformed inflation, outperformed cash rates, so providing a nice, attractive real return to investors. A quick reminder of our universe, it's a multi-asset income fund, so we've got a very wide investment universe. We can take advantage of all sorts of different strategies, but we have very strict risk constraints that we apply to that. Obviously, income funds, you want to minimize the volatility of returns. So if you have a look at the arrow on the right, just a quick reminder, when we're taking interest rate risk into the fund, we keep that limited within certain ranges. The All Bond Index, if you invested in the index of bonds in the market, that's got a 5.5 to 6 year duration, which is a measure of interest rate risk. We will never go higher than 2 for fixed rate nominal bonds. We're currently sitting at 1.4. And if you look at how we actively manage that duration risk over time, you can see how we were sitting very high, close to the upper end of our range, where we saw the risk premium was so attractive going into elections earlier this year at points last year. We've taken some of that duration risk out of the portfolio as we wait for the market to assess the next step. So we've seen quite a big re-rating quite quickly. Obviously, it's going to take some time for all of this good news to filter through to economic growth numbers. And as we're in that holding pattern, we need to be quite tactical and look for the opportunities that present themselves. We've already started to increase duration slightly into recent weakness. We'll continue to do that if we deem it to be attractive. My last slide, and I will wrap up now, Eugene, I promise, is asset allocation over time. Now, within multi-asset income funds, the South African fixed income market is cyclical. It's driven around a growth cycle, an inflation cycle, an interest rate cycle. You should fully expect asset allocation within these funds to move over time in response to that cycle. At the same time, we are at the beginning of what we see to be a structural change in South Africa's risk premium. So we can actively see pockets of value in the market where we feel that that potential path is underrepresented, where we see real value in assets. And you would have seen us increase our exposure to a couple of those. So still retaining what is a relatively healthy weighting to government bonds, giving us that really attractive yield, which does give you an anchor in terms of return expectations. We've been increasing inflation-linked bonds in recent times. That's a blue line third from the top. And then the other structural change, or the change that we're making in the portfolio to take advantage of the structural shift, is we're starting to find a lot of value in government-issued floating rate notes, which are much lower risk than corporates, but at the same time provide you with a better, often a better yield than we can get within the corporate bond market, which has become very expensive. So there are lots and lots of opportunities that we still see in the market. We've got a very diversified portfolio, but we're taking advantage still of what we see as very attractive opportunities within the fixed income space. Eugene, I'm going to pause there because I know you're probably going to boot me off and nudge me gently to tell me that we're going to be out of time soon. So I'll hand back over to you.
Melanie, thank you very much for that insightful indeed. And like I said in the introduction as well, I mean, markets are never without risk and they are unpredictable. So it's not a zero-sum game. We just head into very high duration instruments. And we actually saw a lot of that now in October. And maybe if you can talk us through that, because I mean, to end September, phenomenal returns on income funds. You showed some of the numbers there as well. October was a tough month with US bond yields, moving up despite the rate cutting cycle. And obviously, we know the old story, if the US sneeze, we sneeze, so SA bond yields moving up as well in sympathy for US bond yields. There's a lot of arguing or a lot of debate around the US debt at the moment and debt to GDP. The Blues and the Red team all promise more spending, especially if Trump comes in. I mean, he talks about spending a hell of a lot more. But that's going to push their debt up and they're going to have to issue more bonds. Where will that take US bond yields and what will the impact be on SA bond yields?
Excellent questions as always, Eugene. So just starting off the beginning part of your question, so we did see, as we showed, our South African 10-year did move higher. So it really, really, really strong 10th of September, moved higher in October. And that was, so there were a couple of reasons for that, but the primary reason was that US yields moved higher. So there were two reasons for US yields to move higher in recent weeks. We spoke about interest rate expectations as part of the presentation, but essentially we saw much stronger economic growth data. So inflation remained under control, but economic growth data consistently looked stronger, which meant the market was pricing in more of a no landing than the soft landing or the hard landing that had previously been priced in. So we saw an immediate reaction that US yields moved higher. So that was trend number one. But at the same time, leading into all of the election risks, we saw de-risking. So investors take money off the table, which saw US yields higher. And also South African yields were a net negative beneficiary of that as well. But at the same time, the risks of a Trump presidency and what that means, not necessarily for the deregulation component, but the tariffs, as well as the immigration inflation risks were concerning. And then, as you point out, Trump comes with a fair amount of fiscal largesse. So both candidates, and the US, the deficits they're just too high. We know this, penciled in to be between 6 to 7% as far as the eye can see. It's not unusual to see a 6% deficit or a 7% deficit from a developed market country, but normally it's at times of crisis. So you would expect that during an economic downturn, global financial crisis, COVID, revenues drop, but you have to spend more to stimulate the economy. That's normal, and then it should revert thereafter. Or times of war, obviously, you need to print. Find a whole lot of revenue to spend on your war effort. So that's not unusual. What is unusual is that when you don't have either of those in place, the US is not at war and certainly isn't in an economic recession, to see these types of deficits. And none of the candidates really seem to be understanding the complexity of that and what that could imply. Points of tension within the US debt to GDP. We spoke about South Africa being at 75, US debt to GDP is at 100, but it looks, based on those forecasts, to move eye-wateringly higher very quickly. So we easily get to 136 and then 140% based on these forecasts. And at the same time, when we think about points of tension, so when is debt too much, you can look at things like interest payments as a percentage of your expenditure, and interest payments are creeping up and up and up. They're over 15%. They're probably on their way to 20% in the forecast. That's similar to South African style metrics, and it's crowding out other types of expenditure. So there's always a tipping point. Neil Ferguson, renowned professor, always talks about when your interest expenditure is higher than the amount that you're spending on defense. When that inverts, then you are at risk of losing your status as a global superpower. Don't want to be prophet of doom, but we're at that point in the US. So there are a number of points that we look at that show the vulnerability of the US fiscal state. It doesn't have to matter until it does matter. So we can also have a look at the UK. We can look at, I mean, the classic poster child would be Italy. They've run deficits forever. They carry a very, very high debt burden, and they've got away with it. Yeah, there have been points of tension when we saw sovereign debt crisis in Europe and so on, but they just sail on and they're fine. The US has so many more advantages than that. Reserve currency of the world. They have a natural underpin. It doesn't mean it's not going to matter. It doesn't matter until it does, means that there has to be a catalyst, something which sets the cat amongst the pigeons, and the bond vigilantes come in, and there's fertile ground for them. Could that be the fact that, you know, if Trump takes the presidency now and starts to do all the things that keep me up at night? So things like unfettered tariffs. Tariffs are potentially, they have their place, but the way that he's looking to pull that lever can't be positive for growth, and it can't be positive for the types of revenue generating potential he thinks it has, because you know what, people just aren't going to trade with the US, so they'll just find other places. You know, it's just, they're not going to be able to generate that type of revenue that he's putting down. It's unfortunate we have to learn the hard way, but that is true. So you're going to have a, you know, more fiscal risks. What worries me, and many things that worry me. I'm a bond investor, so I'm worried all the time about so many things. But the other thing that worries me is that the independence of institutions, which has to be strong for you to carry a high credit rating. We know that as South Africa. You know, you've got to have strong national treasury. You've got to have a strong and independent reserve bank. Trump's already alluding to the fact that would like a little bit more of a say in the Fed. We've seen that in history with previous presidents in the past. And that's also not a good strength for US bond investors. So giving you a lot of things to worry about. At the same time, if you analyze trends in the market, these things matter more when the Fed is not the driver. So at the moment, Fed's cutting interest rates. If they continue on this interest rate cutting path and the focus is on the Fed, that should be the main primary driver of most of the bond curve out to, say, the 10-year in the US, where a lot of those risks will manifest themselves, and in that environment will be the longer end. So the curve is going to steepen out in the US, or make it very expensive to fund long term, and you're not going to see investor support. So you're going to see a much steeper yield curve. So when we take bond yields, US bond investments into our multi-asset portfolios, which we have at points in time, because we do think that they give you nice optionality against an economic downturn, we're very careful to choose our point of maturity across the curve. So out until 10 years, Fed should still be the driver. 10 years plus or thereabouts, you're going to see the curve steepen quite a bit. But as soon as the Fed steps away and says either that they're done, or, you know, we're not going to have a landing, so we actually don't need to do anymore, then you would see a lot more volatility in the short end. How does that translate into South African yields? It's one of those fundamental valuation pillars of ours. So we saw this move higher in US yields in October. South Africa followed suit. Our spread to the US stayed relatively similar. There were pockets of weakness. We had a couple of Russian headlines. You know, there were some things that kept us on our toes, but did come back down again. For us to be able to then negate that shift higher, if US bond yields do move higher, we would need to see that risk premium compress further, which isn't impossible. It just means that that economic reform journey, the momentum needs to accelerate quite quickly for investors to start to price that in. So it doesn't have to be completely a negative, but it's absolutely one of the factors that we're aware of, cognizant of, and think carefully about, and fine-tuning that portfolio duration that we have.
A lot of moving parts, definitely not a free lunch in fixed income. That you mentioned the WICB and, you know, SA junk status, and it takes me to one of the questions from the audience. If SA gets off the grey list, or when they get off the grey list, SA government bonds would still be deemed junk. What is the likelihood of foreign investors coming back until the ratings change, and, you know, for us to get out of junk status and back into the WICB? Do you think that's going to happen anytime soon?
Depends how long your timeline is. So a couple of
How long
things.
is a piece of string?
Yeah, so a couple of things to point out there. You know, the fact we're talking about rating upgrades shows you how there's been a sea change since this time last year. So this time last year, we were on the edge of our seat thinking, oh, please, let's not have another downgrade. Please, can we just keep the fiscal course solid so that we don't have to worry about moving into single B rated territory. Now we're talking about, we are solidly where we are. When do we start to see the upgrades come through? So that's important when you're thinking about it from a mindset shift perspective. Rating agencies are slow moving animals. They're very quick to downgrade. They're very slow to upgrade, right? So the first thing that they will do is change outlooks to positive. So that's not a change, that's just saying, well, we recognize that the ship has turned, and then rating upgrades could ensue thereafter. Earliest timing for that, for an upgrade, would be sometime next year. If we continue to keep the GNU intact and that primary surplus is maintained at next year's budget and midterm budget next year, in 2006, we might be able to see another upgrade. That still doesn't get us back into investment grade territory, but investors, they look at that direction of travel. It's always useful when you have a very large pool of investors, and that's why falling out of the WIG-B was such a big negative event for us, but it doesn't mean that that pool is minuscule. There's a decent enough pool that do look at our types of rated countries to invest in, and particularly when they can see a journey or a direction of travel that looks to be improving over time. So it doesn't mean that we're blanked at all. We still would be able to attract a share of foreign flows, leading up to when we do eventually attain our investment grade rating, which if we can get those growth outcomes 2.5% to 3%, which BER, for example, is forecasting we can, with a very quick implementation of quite easy reforms to implement, we could be looking at a future where we're investment grade again. But that's still a couple of years out. We're not there yet.
And I think you hit the nail on the head, because, I mean, the past couple of weeks, we've actually seen a couple of days where there's net foreign buyers of SA bonds. And I think the auctions about 2 days ago also very much oversubscribed, and foreigners coming to our bond market, despite us being a junk. Mel, two more questions. The one is on property, also from the audience. We know that multi-asset flex income funds can allow, I think, 10% into property. We used to see property and income funds many, many moons ago. I think it's about 7 years ago. Of late, no property. I think we've learned hard lessons. It adds a lot of volatility. Will you ever think about bringing property back into your income fund?
Yes, yes. So the point that you make is absolutely right. We are trying to minimize volatility in income funds. We're not trying to, it depends on your income fund, right? I mean, there are different income funds that do different things. What we are looking to do is to minimize the volatility. So for every unit of risk we take on, we have to think about, is that going to be the tail that wags the dog in terms of portfolio returns? And you don't want that. Property has proven to be that type of animal in the past. It doesn't mean we've got a wide universe, we need to use it. So it doesn't mean we're going to shy away from it, but it means the bar is quite high for it to get in. And yes, it's done so well over, year to date. It's been a phenomenal performer. But when we're thinking from a yield constructing, with our yield constructing hat on, we had higher yields on offer in bonds than we had in property. And you had to have a leap of faith that actually things were going to work out for you to generate decent property returns. Whereas bonds, you had that yield anchor. So that was always in your favor. So risk return definitely up until GNU and thereafter really favored bonds from a risk adjusted basis relative to property for this type of fund, for an income fund type of investment. Doesn't mean we didn't have any. We had 2.5% to 3% over this period, with very specific names, what we think are idiosyncratic stories, and attractive yields. And we do have some growth point, which is a barometer for the market direction. But it's not a passive holding. We're very happy to cut or add to that exposure. But I think the days of having 10, 15% as a property within a fund construct like ours just does introduce, it's a broad range of volatility. And if you go offshore, you're introducing even more volatility. So it's just something to be aware of. It doesn't mean it doesn't have its place, but we need to very cautiously include it at the right place at the right time.
Exactly. It's a bit of a tough one, even dealing with multi-asset portfolios in terms of SA property. Moving on back to your fund, last question. You had a very, very interesting slide, well constructed, on your portfolio holding, showing the actual duration of the fund sitting at 1.4, if I remember right. Yes. Maximum going up to 2, albeit sitting at about 5.5. why are you capping your duration at 2? Is it all about risk management and creating more stable returns for clients?
Exactly. I think you've just answered the question for me. That's exactly right. So, we've got, you can either model it mathematically in a theoretical world, or you can back test it. We've got a long track record on the fund. We know when duration is too high, and within a fixed income fund, you don't have the benefit of diversification outside of the fixed income world. So the delta on everything moves to 1 when you have a risk-off environment. So whether it's credit spreads, think about COVID as one example. Bond yields sell off, inflation-linked bonds sell off, credit spreads widen. If you've got anything like a preference share or listed property, an equity-like instrument, they fall significantly. You've got to think carefully throughout all of those building blocks for when there's a negative risk event, how is that going to impact the portfolio returns? Duration is one of those components. We think that having a 2-year maximum on our nominal, so it's our fixed rate nominal bond inclusion in the portfolio, gives us that lever or that ability to be able to put it when we think valuations are cheap. But even then, you're going to have bouts of volatility to be able to minimize that downside risk in the return profile for income funds. It would obviously be different if we're looking at other multi-asset funds, but within an income fund, that's an important goal that we want to achieve, and we need to use the portfolio constituencies to achieve that with strict risk guidelines in place. So as tempted as I was to take it above 2 years, then that wouldn't have been a credible move at the earlier in this year.
No, exactly it. I mean, we've seen a couple of times the past 2 years. Doesn't matter how certain you are, things can move in the opposite direction. So you
Yes.
just never know. Risk management critical. And I mean, you've hit the nail on the head. You've got an exceptionally long and solid track record indeed of delivering consistent returns. To our audience out there, the Laurium income fund available on all the big platforms. If you want more information, give us a shout. We'll get you in touch with Mel and her team. Melanie, thank you so very, very much for your time today. I know we took a lot of time, but it's been very, very insightful, especially what's happening in the world now. A couple of comments from the audience as well. Melanie, thank you so much. Great session today. And we hope to see a lot more of you going forward. Maybe not before the end of the year, but in the new year, definitely big lineups where you are included in so many events. So thank you so much.
Thank you so much. And thank you to everyone who listened today. So appreciated. Thank you so much.
Good stuff. Just a quick
Thank
reminder,
you.
our audience out there, next week, Wednesday, 13 November, Boutiques on Wednesdays again with New Road Capital, Paul and his team, looking at their multi-strategy solutions. Should be proved to be insightful as indeed. Well, then we'll know more or less what's going on in the US, red or blue, what's the impact on markets and on multi-asset funds. Well, thank you very much again. And to our audience, thank you so much. The BCI team, thank you and keep well.